Let's understand the difference between private equity and stock, which other people call public equity. Many people want to know whether they can invest in stocks or private equity. So what do these two terms mean? Private equity means that you buy shares in a privately owned company. That you know someone who has a good idea, who has a good business, and you give them some money to own a part of their business. So when that company makes money, you earn something. That company is privately owned, so its shares are not publicly sold. They are not on the stock exchange. They are not in the market, so they cannot even advertise them or publicize their existence. You must know someone that knows someone who can sell their private equity. Whereas stocks or public equity, because it's also called public equity, is when you buy shares in a company that has been listed on the stock market. That this company is inviting the public to own shares, that anyone can own shares in this business. And so they put it on what we call the stock market. In Uganda, we have companies like MTN, DFCU, Stanbic, and so many. If you watch business news, they always update you about the stock exchange, but no one will update you about the private equity exchange. Anyway, so the question is, where should I invest? Usually, rich people, big investors, have the audacity to invest in private equity because we sometimes work with them and we want capital. So they put money in our company in exchange for some shares or some ownership. However, if you're a small investor, you cannot invest in private equity because the person you're investing in doesn't really need your small money. With our small monies, we can all invest in stocks. But I want you to take note that private equity, if you had bought shares in a given company or in a given business and it has made a lot of money, it is easy for you to get a lot of money. So there are high returns in private equity. Unfortunately, there are also high risks of buying shares in a particular company, especially a private company. When it comes to stocks, the risks are low, but there are also risks. So I always advise people, if you're going to trade in stocks, if you're going to invest in stocks for wealth creation, meaning it's a business you're going to be doing, you are going to be actively in the trade, then you must keep up to date with the business news, with the economy, with the currency, with the management of your company that you've invested in. So the moment the stocks start going down, that's when most people start selling. Now for you as a trader, that's where you should buy. Because most people are afraid, but for you, you're hoping that when you buy at a low price, when the stock of this company, let's say you bought the stock at 10,000 and it's now going to 50,000, when the stock of this company is now rising to 35 and you bought it at 20 when everyone was selling, or at 10 when everyone was selling, then you are making a margin. However, if you're a person who is investing for capital accumulation, all you have to do is know the price of the stock of that particular company, the management of the company, if possible, know the annual general meeting of the company, invest, buy shares, and then wait at the end of the year to receive the dividends on your stock. Dividends means profits that come to you owning or investing in that particular company. Now, there's a difference between someone who is investing for capital accumulation and someone who is investing for wealth creation. Wealth creation, you're trading and active. Capital accumulation, you just invest, put money there, and you hope that the company will make money and share in the dividends. Now, I think the major difference between private equity and stocks is that if you invest in private equity, you're an active investor. You cannot just go and sleep. You literally, and in most cases, you're actually part of the board of directors. You should know how this business is running, and you should know how to fix it when it is not going well. When it comes to companies that have publicly listed their shares on the stock market, you have but less you can do in the day-to-day management of that particular business. So private equity, from a private company, you buy ownership or you buy shares. Stocks, you buy from a public company or a company that has listed its shares on the stock market. From both, you expect to earn from the dividends or from the profits of that particular company. On Tuesday, we are going to have a TikTok live on bonds and treasury bills. We are going to host an expert who will answer any of our questions. Thank you very much. Remember to always follow.